Hello, everyone. Welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas. I'm the co host here alongside Stephen Thomas, the founder and chief economist of Reports on Housing. Today, we will discuss the most recent news and economic news and statistics, post election housing market, the latest Federal Reserve meeting, cash buyers, and of course, so much more. But first, like usual, Stephen, what is happening in the ginormous Thomas household?
Well, flag football is done. Cross country running, nope, it's hitting, going. I mean, we had league finals, and then we're going to move off to CIF prelims next week, and then it's CIF finals, and then after Thanksgiving it's state, and then she's supposed to do something else beyond that because she's running so fast. So we're living vicariously through her. Everybody else, everybody enjoyed Halloween. She had to remain on the sofa and answering the door because the one that runs because she had to run the next day. So that's what's going on in our neck of the woods. Not a whole heck of a lot. It's right. We're getting very, very close to the holidays. That's where everything's going to be a lot of fun. So that's going on with us. How about you, Mr. Brennan Joseph Thomas?
Oh man, I mean, a little bit has happened. If you know me personally, you've known that I've worked two jobs. I've worked at a pizza restaurant, so our family restaurant, for since I was like 14, all back and forth within college and whatnot. And as of yesterday, November 7th, I called it quits. So I definitely did my time there. It was just absolutely thrilling being able to grow with so many people and really learn to trade and everything and really come to appreciate everything that there is in the dining service. So I got to see so many different aspects of life there and learn so many different things that I never knew I could. And that finally, that chapter is coming to a close. And now I'm just working with you, which is crazy to say, only with you. But it makes me super excited for what's in store for me, whether that be playing soccer or doing something different. But other than that, I mean, I don't even want to talk about Arsenal because we've been in the biggest slump I think I've seen in a couple of years, and it's absolutely heart wrenching. But that doesn't mean I don't watch the games. I will always watch them and support them. But I mean, other than that, it's been pretty same old for me. Looking forward to Thanksgiving. That's right around the corner, and I mean, it's been a year and a half of me working with you, so it's been an absolute pleasure, and I'd like to say thank you because you took a chance on me, and this has just been absolutely so much fun, even the podcast itself. So, but first, let me ask, because huge talk of the town after the election, of course, what happened at the Federal Reserve meeting?
Well, I was mistaken. I thought they met on the day of the election, and I forgot. They don't meet on the election day because they're out voting. They actually met the day after on Wednesday and then gave a rare Thursday announcement. And they announced that they were going to cut by 0.25%. No surprise to anyone at all. And there were some people that said that they weren't going to do anything because of the stronger jobs readings and that were in October for September and a few other reports that were a little bit stronger, but that's notorious for October. Some of that stuff is seasonal, and it's also one data point in the whole series of things. So really, it boiled down to the Q&A. And I loved his Q&A. His Q&A was the most on point and precise, and very much felt this is one of the very first times where I felt like, man, it feels like they finally are starting to get it. I wish they would be a little bit less data dependent, and I wish they'd come off of that narrative of being so dependent upon all the data. And I also wish that the Federal Reserve didn't speak as much as they did, because there's like there's several speeches every single week. So, but other than that, this particular speech, as well as the Q&A, really said a lot about they're going to continue the course until they see something that looks outrageous going the other direction. But they've already articulated what they're going to do, and it really feels like they've committed to doing what they're going to do. And that is, they know that they're too restrictive. He mentioned that they're too restrictive. And like I said, it was probably one of his better speeches, and he kept things a little bit more concise and buttoned up than in prior Q&A and speeches where it kind of went off the rails before, and some of them where he gets caught on a question and then answers too much. He did a really good job this time. And when I'm saying he, I'm talking about Jerome Powell, the Federal Reserve chairman.
Now, the Federal Reserve decided to cut by quarter of a basis point. And what would you say happened over the economy over the past couple of weeks that led to that cut?
Yeah, it's not necessarily over the last couple of weeks. It's over. They still know that they're too restrictive, and they've already committed to the pathway that they're going to go. Unless things were to break out and all of a sudden we saw a resurgence of inflation, which we're not going to, or jobs, all of a sudden we're creating way too many jobs, which also is not going to happen. So it's more of, we know the course that we need to go. He did state that if he sees things deteriorate more, they'll go down more rapidly. If things start to heat up a little bit, they'll slow things down a little bit. So, I mean, he's going to exercise the brake and pedal and the gas pedal based upon what they're seeing in the upcoming numbers, which once again means they're so data dependent, but they know that they're too restrictive, and that's what they're referring to. And we've been saying that they should have gone way earlier this year. So far, they've only done what's equivalent of 3 rate cuts. But if you remember back in June, they said 1. And I thought they were foolish for even talking about just 1. I knew how restrictive they were. I knew of that there was plenty of headwinds and negative readings in the economy that nobody's really like isolating or talking about. And that is what ultimately leads to slowing down even further unless you move. And that's why they're moving, because they want to get in front of things slowing down too much.
And if you don't believe Steven, I can actually attest that he's been saying that they've been way too restrictive for months before they even really talked about the cuts that they're doing right now. We've just gone back and forth during every single press conference saying, oh man, they got a cut right now and they're still holding on. And it was just frustrating to see. So it's pretty cool to see that. I mean, what you said is actually coming to life now. They were too restrictive and they're really following up on, okay, how do we go from here, fixing what happened in the economy and to move forward in the positive direction. So definitely interesting to see. And hopefully you guys can trust Steven even more now. But Steven, what's been happening in the real estate world with supply, demand, and expected market time?
So we had rates pop above 7, and they were there for a little bit of time. We had rates, keep in mind, prior to the 0.5 point rate cut in the short-term rate. What happened to long-term 30-year mortgage rates since? They went from 6.1 all the way up to 7.1. So that's a full percentage higher. Now, they were stuck above 7, not for that long, like 9 days, but then it came back down yesterday. We're recording this on Friday the 8th. That was yesterday the 7th. They came underneath of 7, and then they came further underneath of 7 today. So we're now under 7. We're in the 6s, and we're not all the way down to where we were before, but it just shows you how hard it is now to stay above 7%, even though you got these different readings and all that, because we're going to get enough readings that's going to bring that rate back down further. And I'm just hoping we can get below 6.5 by the end of the year. And that is where I'd like to start 2025, because what happened when it's so restrictive in the 7s and it went from 6 all the way up to 7, such a big change, it really stomped on demand. We were looking at it and it looked good, and then all of a sudden, the higher things got, the more gummed up everything got, and we saw inventories. Inventories recently in most markets have actually peaked. All of SoCal, the inventory has peaked and it's coming down, but demand fell sharply in the last couple of weeks. And that's from being at these higher rates. So if we have this small drop in inventory, but a big drop in demand, in pending sales activity, that equates to a longer market time. So when they going down at the same rate, that's where the market time doesn't change. The market feels the same, and that's typically what happens during this time of the year. But right now we're not getting that because every time rates get above 7, it really gums things up. So now that we're below 7, that should help things out. The further it gets down below 7 and into the sixes, the better we are off for 2025, because that's kind of what we've been dealing with right now. I don't like that pattern. It's not good for the overall housing, and it's just going to gum things up more.
So now that the election has passed, which was on Tuesday, which is crazy to say, what has changed in the housing market?
Yeah, well, the funniest thing is, very next day, what happened to, oh, everybody went crazy. Everybody's buying stocks. This is great for the economy. The economy's going to boom. It's not booming yet. I mean, we've been doing really well. The overall economy has been really, overall, still pretty strong. It's still been thrusting forward, but you can't watch the stocks continuing to rise without profitability continuing to match those kind of rises. And it just doesn't match. And especially with how restricted the Fed is, it doesn't make a whole heck of a lot of sense. So you get this overreaction, and that's what markets love to do. They overreact to everything. I refer to it as that initial scratch in your brand new car. That is just that initial scratch in your brand new car where you freak out, you overreact. And that's what they do. I'm talking to investors across Wall Street. They do on everything. Positive, negative, they overreact to it all. So this was an overreaction. And then certainly enough, the very next day, what happened? Things kind of like they went the different direction, and that's why we saw interest rates at first go as high as they did. They were all the way up to 7.13%, and then they came down. Now they're below 6, or in the right just above 6.9%. So rates have eased back down, and then we're going to watch data going forward. This is this absorption of the election. That's the only thing that will affect housing overall. What's affected is they were overemphasizing how great the market was going to be. So as a result, everybody piled in stocks for days, and nobody was buying bonds. That's why rates came up as much as they did, because people were saying, "Oh, we're positioning ourselves for a Trump presidency." But then afterwards, they realized, okay, back to business. A lot was sold off because it was over. I mean, a lot was bought in the 10-year treasuries, and mortgage-backed securities. Interest rates floated down, and now it's coming back to where it should be. I would argue still too high. Probably should be right around 6.75. And then once we get these other prints, economic prints down the road, like that first jobs report in December, which will be for November, hopefully it comes in where it's a lot more muted, and as a result, we'll get rates to come down below 6.5%. So that's kind of where what things have done since.
So I know you did a housing debrief on this topic, which is super interesting that it came to me almost out of nowhere. At least this idea, but the question is, about a year later, there are no talks or near no talks of the Airbnb crash. Stephen, what has happened with the Airbnb market? I mean, where is the crash that everyone was calling for?
Drives me nuts. And the reason it drives me nuts is because this is just one of those, this is where we're going to get all the inventory. It's going to be this Airbnb crash. And even if they all came to market, we could have absorbed a lot of that, even though we've had more homes come on the market this year. So it would have led to some values dropping, but that's not what happened. Actually, Airbnb demand is up. Profitability for Airbnb, if you look at it, there's you can go get all these metrics. Actually, we did one of our housing debrief YouTube videos on this Airbnb crash that never occurred, and you could see all the different metrics from it's called AirDNA, and you go there. They have a whole bunch of charts, and they have some really smart economists. This is their lane, and you can actually see profitability up. You could see demand up. You could see that the supply is not continuing to grow at the robust pace that it was before. And then all these markets like in New York, where they shut down the ability to have Airbnbs on a nightly basis, you had to rent out for a month or more. At the end of the day, it didn't add to the inventory. As a matter of fact, New York, the New York City, the values are actually going up. at a bigger clip than a lot of the rest of the country. So, and it should have added a whole bunch of homes that came to the market. No, what it ended up doing is it added to the number that became 30-day rentals plus, and it added to the rental market, but it didn't add to inventory, because that's what the argument is. If they didn't do this, this would just become inventory, and that's not what's happening. It was not the result, and that's what everything shows. No crash. It's not going to happen. It's not going to occur. This is just one of those doomer and gloomer ideas that somebody pops up while they're driving and says, I'm going to talk about this and get 10,000, 20, 150,000 people to watch so that I can get paid for my YouTube channel.
That is the most annoying thing I think to see. But from a study done by the National Association of Realtors, they found that Americans who bought homes in 2024 were older and richer than ever before. Stephen, can this be seen as a good or a bad thing?
Yeah, it just means that the only ones that can afford to purchase right now are the older and richer, the people that are more established, the people that have more net worth, the people that have bigger bank accounts, that have leveraged relationships and with banks and things like that. It just means that it's right now, it's very restrictive to purchase. It's not opening it up to enough people. This whole entire year was one of those years where we've spent about 7% during spring and summer, the exact wrong time to have a 7 as a starting for interest rate. Yeah, next year hopefully lines up better, below 7%. Our prediction is at least between 6.5 and 7, and we have made the case for 6 to 6.5. And I don't believe we're going to get a repeat of 7% plus for another year. That lines up during our spring and summer market. So if we get that below 7%, we're not going to have it be a whole bunch of people that are well established, older, and have big bank accounts that are able to purchase. It'll open it up to more and more people the lower it goes. We were at 6% for a minute, 6.1% for a week prior to the half a point drop, and we saw a definitive jump in demand. And that's not from the people that are well established, the big bank accounts. It's everybody else that's been waiting for rates to come down. Too bad it only came down for a week. We need it with duration.
Currently, there are about 30 renter households for each available home for sale, up from less than 10 in 2006, according to Freddie Mac's latest market outlook report. So, is this a cause for concern?
We have not been churning units like we did in 2006 or then. Remember, we were churning units back then because of all the ridiculous different mortgage products that were out there that got us into the disaster known as the financial crisis. Those haven't existed since. So we don't have the same number of borrowers or buyers that are out in the marketplace. But it is that you can compare it to when it was really good, when we were doing funny money stuff. But at 10, it's too low. It's someplace in between. We're right now transacting at a very, very low rate. And in California, where we're at, the rate's even less. The last time we were at these levels was like in 1996. So we definitely need to see more people participating, more buyers able to purchase, more houses available. And the only way that's going to happen is with rates continuing to drop, and it will open up more homeowners placing their homes on the market, which will also allow more buyers and more renters to be able to finally step in and purchase.
So, now that we are fully entrenched into November, just over a week now, do you have any predictions for 2025?
Man, it seems like November's been here for a year, but do I have any predictions for 2025? Yeah, I've already kind of like talked about it. We're going to be doing a forecast on in December that will be on YouTube. We'll also post it to Facebook, because there's a lot of real estate the industry that's on Facebook. At the end of the day, what we're starting to see is that it's very, very much, it's however interest rates line up with the spring and summer housing market, that is going to translate to how the year's going to be. It's not looking very good for 7% plus interest rates to be the base case. That's not what's going to happen. That is my asterisk case. The base case is between 6.5 and 7. And there is still a strong case for 6 to 6.5%. If we get to 6 and 6.5%, we're going to be adding like 12 to 14% as far as number of units closed year over year, and that it seems like a whole heck of a lot, but easy to do when the number of transactions we've been doing for the last 2 years has been so low. It's not even going to get us. It'll get us closer to where we were prior to COVID, but it's not prior to COVID times, and it's definitely not the way it was back in the 2000s that you're alluding to. So, but it will be definitely a step in the right direction. Even at 6.5 to 7%, which is the base case, we're still adding a lot of transactions. We feel like it's going to be between 8 and 10% more transactions. So it's between, and then if it's at 7% plus, we're looking at not a whole heck of a lot more transactions, like 0 to 2%. But that, like I said, is the asterisk case. Something disastrous has to happen. And the disastrous thing would have to be that the economy is doing far too well, and the Federal Reserve has to remain restrictive for longer, which means higher rates. And that would just not be a good case, because eventually the walls would come tumbling down if we continue to go down a path that would be that something like that.
According to Connecticut Insider, Zillow is now adding climate risk score to its listings, impacting Connecticut homebuyers and sellers. Are we underappreciating how much of an effect does natural disaster and climate risk have on real estate?
Yeah, I don't think that everybody thinks things through. I don't. I think a lot of times it's got to become more of a disaster where it really does ultimately affect pricing. Has not quite got there yet, but is it coming? Well, absolutely. If we continue to have more and more hurricanes, rising sea levels, more fires, more tornadoes, all that can really lead to higher risk of some climate disaster, which would ultimately lead to insurance problems, insurance premiums being higher, as well as home prices, keeping a lid on home prices. So it's not materialized yet, but it's definitely in the works, which is why something like this is even occurring, because you have to recognize it definitely is a problem, and it's continuing to grow. So this ultimately is something to watch. It's not here yet, but it will definitely evolve over time.
And more than a quarter, so 26% of home buyers in the United States over the past year paid cash for their home purchase, which is an all-time high according to the National Association of Realtors. Can we expect the number of cash buyers to decrease, or at least the percentage of, in the near future?
When we get more transactions, the transactions aren't going to be coming from cash, because, like I said, what it is it's becoming more affordable when rates fall, and now you get this big jump in demand. Well, that big jump in demand comes from people waiting for rates to fall. That is not there. That wouldn't be describing anybody that's holding cash. So because it's been so restrictive at these higher rates and affordability is an issue, that cash doesn't care. They're able to play no matter what. So they've been playing, and they're just a bigger chunk of the a bigger piece of the pie when fewer people are playing. As we get a jump in the number of pending sales and the number of closed sales, where's that jump come from? The people that are now getting loans. So the percentage of cash buyers will begin to dwindle because there's going to be more people looking for loans that will be purchasing as soon as rates come down enough.
Amazing. Well, thank you everyone again for tuning into another episode of Let's Talk Housing. If you want to learn more about what's going on in the real estate industry across Southern California, the Bay Area, Phoenix, or Las Vegas, feel free to check out our YouTube or subscribe today at reportsonhousing.com. Please leave us a good review. We always appreciate it. And if you have any questions at all, feel free to post it to any of our social media platforms, or you can even email me personally at info@reportsonhousing.com. We'll see you soon, and have a great rest of your day. Thank you.
Thank you.